When you look at the stock market, it's difficult to understand why each stock is priced in such a way. I mean, look, we all have heard the news that Apple is the first trillion-dollar company. It's world's biggest and most successful company. Maybe the stock price should be higher as well, right? Not really. The reality is quite different. Apple's stock price right now is $258, while a company that's hundreds of times smaller like NVR Incorporated has a stock price of $3,000. Does that mean that NVR Incorporated is bigger than Apple? The short answer is no. However, it's a little bit more complicated than it might seem. In fact, the entire stock price seems quite complicated at first look, but there is a logical explanation behind most of the things. To make a sense out of the stock market, we have to understand what is the stock in the first place. Let's say for the last 6 months, you have been thinking of starting a business. The only problem you have is, you don't know what business to start. One day on your way to college, an idea strikes your mind. You pull out your phone and write it down. You rush to your house and start planning. Everything looks perfect. You know how to turn your idea into a multi-billion-dollar company. Congrats. But it's too early to celebrate because you don't have the capital to start. You gather your family members and you explain to them the idea, hoping that they will invest in the company. Everyone thinks you're crazy, except your uncle, who decides to bet on you. $10,000 in exchange for 20% of the company. It might not seem much, but it's actually a lot, because your uncle just valued your idea that's not proven yet at $50,000. So you register your company and issue 100,000 shares, and your uncle gets 20,000 of them. You start building your website and designing your product. In a few months, you run out of cash and you need to raise more money. Unlike last time where you simply had an idea, now you have a concept to present. So instead of going to your uncle again, now you can do something different, like talking to some of the big guys, such as angel investors. Angel investors are usually the rich dudes who are looking for innovative ideas or young entrepreneurs to invest in, something like sharks in the Shark Tank. It's not easy to convince these guys to throw money into your business because statistically 9 out of 10 businesses fail, and you have to prove to them why you are an exception. After talking to multiple angel investors, luckily you could get one of them on board. But first, you have to agree on the valuation. There is pre-money valuation and post-money valuation. It's not as difficult as it might sound. Pre-money valuation is how you value the company before receiving the investment, and post-money valuation is pre-money valuation plus the investment. The higher the pre-money valuation, the less portion of the company the investor is going to take. You enter into a negotiation and you convince the investor to throw $1 million into your business with $2 million post-money valuation. So the investor is going to take 50% of the company and your shares will get diluted together with your uncle's one. That doesn't mean you're going to have fewer shares. The company will simply issue another 100,000 shares for the investor. So now there are a total of 200,000 shares instead of 100,000 shares, and your stake is 40%. With $1 million, you rent an office, hire some designers, engineers, and specialists to complete your product. Finally, everything is ready. You're about to launch your product, app, service, whatever. But guess what? You're out of cash, and you still need a marketing budget and salespeople. So you decide to raise some more money. You go for a Series B. This time you meet some VCs or venture capitalists. They're not your typical angel investors. These are dudes with MBAs and work in venture capitalist firms who take other people's money and invest in companies such as yours. Anyways, after multiple negotiation, they decide to bet on you. Since you already have a team and a product to launch, your company hopefully now worth more. Let's say the VC offers you a $10 million investment with a $20 million post-money valuation. You find that offer fair and you accept it. The company issues another 200,000 shares and everyone's stake gets diluted again, since the VC just purchased 50% of the company. In case you're wondering, no one has lost money so far. In fact, everyone just got wealthier. The angel investor, for example, had 50% of $2 million when he invested in the company. Now he has 25% of a company that's worth $20 million. In fact, your stake worth now $4 million. Anyways, you can go for a Series C, D, and so on. Few years has passed, congrats, you have made it. Your idea turns out to be a success. Your business is finally making money. Remember, everyone who has invested in your company has been waiting for you to grow big enough so that they can cash out. Especially your uncle whose $10,000 investment now worth millions. You have two options. You either get sold to one of the giants of the industry like Instagram did, or you go public like Facebook, and that's known as IPO, Initial Public Offering. It's just another way to raise funds and issue shares, but this time anyone can buy your shares. They're open to the public. Your uncle and that angel investor can sell their shares and make a fortune. In fact, people can buy and sell your shares among themselves in the stock market. So before going public, the stock price is determined by what you and the investor would agree on. But after going public, the number of factors that would influence the price slightly change. The laws of demand and supply would determine the price. Facebook went public in May 2012 at $38 per share, valuing the company at $104 billion. But the public did not agree with Facebook, so the demand for Facebook shares wasn't as high as the supply. Therefore, on the day of IPO, the stock price dropped to $18 per share. But Facebook still managed to sell enough shares to raise $16 billion, making it one of the largest IPOs in the country. The price of the stock price doesn't accurately present the value of the company because the number of factors that can influence the demand and supply of a certain stock are just too many. Let's just say hypothetically, some kind of a disease would spread around the world that would push the media to talk and exaggerate about how the disease could crush the economy. That would scare off immature investors and would push them to sell their stocks before the market would go down, as the media said. So the supply of a certain stock, let's say Facebook, would be much higher than the demand for it in the market, which would push the price to plummet. And that could scare off the rest of the investors and push them to sell their shares as well before it drops even farther. Even though this particular disease in any way isn't affecting Facebook, it still forced the stock price to drop significantly. Here is another example. The company might realize its earnings for the last quarter, and they might not meet the expectations slightly. That could get some negative press, and negative press could easily push some investors, especially immature ones, to sell their shares, and that would increase the supply of the shares and would drive the price down, and even scare off more professional investors. It's a never-ending cycle. That's why a panic over a crisis can destroy the economy. The company might not be making a profit for years or decades, but because it seems like sometime in the future it is going to make a lot of money, investors would keep buying its shares, hoping that one day it's going to pay back. And that hope would keep the price rising, like in the case of Amazon. It didn't make a profit for 20 years, and it made Bezos the richest man in the world. If a company would keep doing great, the stock price could rise to unbelievable amounts. Berkshire Hathaway's stock price peaked at $340,000 a share in February. Yes, you heard it right. A single stock cost $340,000. That's what it takes to invest in Warren Buffett's company. So some companies play around with their stocks to increase the demand for the stock by splitting their stocks, for example, to keep them attractive even to small investors. Take an example of Apple. The stock price currently is $247, but did you know that in June of 2014 it was $650? That doesn't make sense, right? Because the company doubled its market cap and iPhone sales skyrocketed since then. Then what does that supposed to mean? Let me explain. In June of 2014, Apple split its stocks 7-for-1. In simple words, Apple divided each stock to 7 stocks. So the stock price dropped to $92.7. So if you had one Apple stock back then that cost $650, now you have 7 stocks, and each of them cost $92.7. Nothing really changed, but the stock price seems more affordable now, which increased the demand for them. Hence, the price would rise as well. The number of factors that could influence the stock price are way more than we can possibly cover in this video, but here is the catch. The trick is to find out if the price of the stock does really represents the true value of the company. If it's overvalued, it is not worth investing because sooner or later the price of the stock will drop to its real value. On the other hand, if the stock price is lower than what the company really worth, then it's a great investment since the stock price sooner or later will rise to its real value. I hope you guys have enjoyed this video. Make sure to give it a thumbs up and leave a comment because that will really help the channel. And of course, hit the subscribe button and the bell besides it if you're new around here. Thanks for watching and until next time.